So in this video, I want to talk about an NVIDIA earnings trade I made. So February 13, NVIDIA was going to announce earnings after hours. NVIDIA was trading at around 270. So the trade I made to benefit from earnings volatility. So obviously before earnings is announced, there's a lot of volatility in the stock in the option premiums. So the trade I like to make regarding earnings is to sell options. But of course, I don't know which direction NVIDIA is going. I don't know if it's going to go up or if it's going to go down. But I know I want to sell options. I'm looking for a strategy where I can sell collect premiums, and then hopefully after earnings, when volatility goes down because there's no more mystery, then I can buy back the options strategy for less than what I sold it. So I like to use a website called Earnings Stats. They look up all the earnings results for the past 10 years of a particular stock. So according to Earnings Stats, NVIDIA has opened inside the expected move 71% of the time. This is in the past 10 years. It has also gone up 64% of the time. So after earnings, NVIDIA has gone up more times than it has gone down after earnings. In fact, if you look at this table right here, really summarizes it perfectly. So you could see that for the past 10 years, actually this is more than 10 years. This is since 2003. So you could see clearly that it has gone up more times than it has gone down. And most of the time it moves within the expected range. So the expected range is the gray zone here, and most of the time it stays within that gray zone. It has a few times where it has gone past. So over here it's gone past 2004, over here it's gone past way below, and only 2 occasions where it went down and outside of the expected move. And then you've got 3 occasions where it went up outside of the expected move. Now this is four earnings per year since 2003. So it's about 69 earnings analyzed. So based that it moves up more times, and 71% of the time it stays within expected move, and its average move is about 81% of its expected move. So how do you calculate expected move? First of all, you look up the option chain of the stock that you want. Now, of course, I'm not going to be able to calculate the expected move because earnings has already passed, but this is how I would calculate it. I would go to the iron butterfly strategy because the iron butterfly allows me to sell the at the money put option and the at the money call option. And for example, right now, NVIDIA is at 289. So I would go to the 290 strike. So I would look at the at the money call option 290 and the at the money put option 290. So leg 1, leg 3, and I would look at its value 475, 480. So the expected move of NVIDIA by February 21st is about 10 points. That's how I would calculate expected move. But of course, before earnings, expected move was higher. I think it was about 25 points, almost 30 points. So here's the trade that I made. I sold a put credit spread with an expiration of March 13, so 30 days out. So it has an expiration of 30 days. I sold a put credit spread at a 245 strike. So when NVIDIA was trading at around 270, I sold a put at 245 and I bought the 240 put option. So by selling the put option, I got money, and then by buying the put option, I had to pay. But the combination gave me $88. I was left with a net credit of $88. That's a $. So how does this work quickly? I've got a video on put spreads. I'll link it below. But just quickly, for me to keep this $88 by March 13, so by the expiration of this options trade, NVIDIA needs to stay above 245 for me to keep this $88. Because the option that I sold here, I started a trade. I can't just sell it and just ignore it. I have to close it. So to close an option that you sold, you have to buy it back. And to close an option that you bought, you have to sell it unless they expire worthless. And for them to expire worthless, they have to be out of the money. And for them to be out of the money, in the case of put options, they have to have no value. And they'll have no value if the stock is trading above it. The only time put options will have value is if the current market price is below the strikes of the given put option. So basically, for me to keep this $88 net credit that I collected by selling these two, by selling the 245 put option and buying the 240 put option, NVIDIA needs to trade above 245 come March 13. But the idea of this trade is when earnings is announced, there's a volatility crush in the premiums, so the value of the premiums go down. So the option that I sold over here, I can buy it back for less. And of course, the option that I bought, I can sell it. It'll be for less, of course, but the combination will allow me to close this trade for less than what I collected. So in fact, the next day when earnings was announced, NVIDIA was trading at around 290. So because of the volatility crush after earnings and because NVIDIA ended up going up, this $88 that I collected, I was able to close this trade out for $23 the next day. So really, I've got two choices. Either I wait till March 13, so I wait 30 days to make a full $80, right? $88. Or I can make the difference of 88 minus 23, which is what, 65? Or I can make $65 in one day. So what's better, making $65 in one day or making $88 in 30 days? So you have to wait an extra 29 days just to keep the full profit. And maybe, who knows, maybe Nvidia drops back down below 245 in 30 days. So obviously the smart decision is to close the trade, which is what I did. So I closed it for $23, made my $65 profit in one day. But what's even better is the return on capital. So to place this trade here, actually, the capital required is the difference between the strikes minus the credit that you received. So the difference between the strikes is $5 or $500, and the credit that you received is $88 in this case. So the capital required is $412. So $412 is the capital required. And I can actually lose $412 if by March 13, Nvidia is trading below 240. So there is still a chance that I could lose on this trade if Nvidia is trading below 240 come March 13. But as you can see, it's a small chance of that happening. It's possible, but there's a small chance. And it's going to take, so my return on capital really is $65 divided by $412. And that's just in one day. So it's about 13% return on capital in one day with this earnings trade. And that's just one contract. I only sold one contract. If my portfolio allows it, I could do 10 contracts. So it would have been $650 over $4,120 of capital in one day. So that's what I like about this type of trade, is that it's very scalable if you've got more capital. So now, what would have happened if Nvidia, instead of going up, stayed around 270 or even dropped? So if it stayed around 270, I would still do nothing because my short strike is 245, so I don't have to worry. I could probably close the trade also, but definitely not for $23. Probably would have been able to close it for $45 maybe if Nvidia stayed at 270. And what if Nvidia dropped? So as long as it stays above 245, I'm not going to do anything because I've got until March 13. I've got 30 days to go, so I don't have to worry about it. Now, what if Nvidia blew way past 240 and dropped below 240? Now, first of all, we saw that according to earnings stats, that doesn't happen often. It's very rare that it happens. It could happen, but it's very rare. 2 times out of 69 times it happened. It dropped 30% and it dropped almost 20%. Most of the time goes up or drops a little bit. So you can use her historical probabilities, historical stats to find out what the probability of success is for this trade that you're making. But if it had dropped below 240, I still have until March 13. It might come back up, so I don't have to take action right away. What I could do is minimize my loss. Instead of having a max loss of $412, I could start doing the opposite. I could start selling a call spread and collect a credit with the same risk. So I know this is a little messy. I'm going to change the color here. So let's say Nvidia opens at around 230 after earnings. It's trading at 230. What I could do is, first of all, I've got 30 days to go, but what I could do is maybe sell a call spread at around maybe 250 or maybe even at 245. Really depends on my assumption if I think Nvidia is going to come back up quickly or if it's going to stay down. So I could sell a call spread. So the same thing as this put spread, but on the opposite side, I'll sell a call spread. I'll collect the credit. So let's say I go to 260. It's just an example. It doesn't have to be these numbers. So I would sell a call option at 260 and I would buy the 265 call option. So notice I keep the same distance between both strikes. So 240, 245 is 5 points and 260 and 265 is 5 points. I do that so that I don't add additional risk to the trade, because whether Nvidia is trading below 240 come March 13 or above 265 come March 13, I would lose the same thing. I would keep my $88 profit if Nvidia is trading above 245, but because I'm actually selling a call spread, I'm going to collect a credit from that, let's say $50. So if Nvidia come March 13 is trading between 245 and 260, I'll keep the credit of 88 plus whatever new credit I collected from this new call spread. But the idea of selling this call spread is actually just to reduce my max loss of $412. So in this case, Nvidia went up, but if it had gone down, like I said, I have 30 days to go. If it goes way below my strike of 240, then I can start selling a call spread on the other side to reduce my max loss of $412 and then close the whole trade whenever I can. All right, so just wanted to share with you this earnings trade I did on Nvidia. So if you have any questions, leave them in the comment section below. And like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.